The combustion age is ending. The electric age has begun. I lifted that from the website of 888 Capital because it struck me as a very simple expression of something that we talk about all the time, but still perhaps are searching for the best way to invest around the clean energy thematic. So to help clear some of it up, Roscoe Widdup, PM and co-MD at 888 Capital joins me now. Hi, Roscoe. Thank you for joining us.
Thank you for having me.
Because that's the thing. We all seem to know and accept that decarbonization is a major thematic. However, investing in clean energy technologies it's not been easy.
And let's face it, over the last 2 years, this sector has faced incredible headwinds. At the more utility end, so the lower volatility end, these stocks are down 50 to 60% over the last 2 years. And at the more technology end, earlier stage, high growth companies have fallen 70 to 80%. Pretty extraordinary falls. So what's the root cause of that? And rising interest rates is at the top of the list. If you look at, there are only 2 S&P 500 sectors that are down since rates started going up in March of 2022. That's power utilities and real estate. Power utilities sit at the centre of the clean energy universe, and they have felt incredible headwinds. They are highly correlated. It's a sector that is highly correlated to interest rates. Then if you think about solar and wind and batteries and hydrogen and all of those other they are in the supply chain of power utilities or an alternative too. Yet they are earlier stage, more volatile companies, and most importantly, they are small, what are considered global small caps. They are small companies, typically less than 10 billion in market cap. So in addition to power utilities being one of the worst performing S&P 500 sectors over the last 2 years and down over 2 years, small caps are also down over 2 years, and that has hit clean energy squarely in the face.
So perhaps you could call it a perfect storm. But often when you hear that something's been a bit battered and bruised, that then breeds opportunity. So before we get to that, let's take a step back, just explain what you do at T8 Capital and what you're sort of interested in when it comes to this clean energy thematic, because to your point, there's a whole range of ways to play it.
And there's a lot of misconception out there in the general public. So our focus, we invest in renewables, energy storage and electrification. And within those 3 verticals, we will invest in anything from a consumer product all the way through the supply chain to basic raw materials. And what we do at T8 is we scour those industries for the really attractive sub-industries and segments and companies that are hiding there. And we look for our 4 key characteristics. Great fundamentals, typically through margins and exposure to these growth rates. Secondly, we look for industry leadership. We don't want an industry laggard, we want an industry leader that is driving the industry forward and has got market share and technology leadership if possible. Thirdly, we want staying power through a strong balance sheet and a good capital structure. And lastly, we want competitive advantage. And that is typically retained through technology leadership.
So when you are considering, I thought it was interesting to see the companies that you're investing in, Albemarle was on it. So you're talking right down to the miners. You'll look for those opportunities.
Correct. And what is Albemarle? It is the world leader in lithium extraction. It is the largest, most liquid lithium company. One of the things that we look for in a situation when we're looking at commodities is these are a volatile, deep cyclical segment of the equity market, and we typically would like to get exposure to the commodity. When you invest in a producer, you are taking on a range of idiosyncratic risks. Mm-hmm. So in the first instance, when we're investing in a commodity producer, we're looking for the lowest risk way to get beta to that commodity.
Now, when you outlined what the headwinds have been for some of these clean energy companies, a lot of it comes to the macro environment. Well, we're now hearing that rates may stay higher for longer. So does that push out outperformance as far as time frame goes?
On the balance of our research and analysis, it's the rate of change of rates rising which is the key headwind. And I think anyone would argue that we're much nearer the end than the beginning. But that said, if we do have higher for longer, what does that mean? Does that mean there's an absence of a tailwind? We don't necessarily think so. We think a lot of the pain and the damage has been done, the valuations are attractive, and even through that period, we believe there's increasing recognition that the fundamentals of these businesses are intact. And then also what we'd say is that we are in a really uncertain environment where we go data point to data point. There are surprises either way in terms of inflation, unemployment, etc. People's investment portfolios, there are benefits in diversity. People know what's worked over the last 2 years, and you're either there or you're not. But the future is uncertain. And what this would add to a portfolio, it's a great entry point to a secular growth thematic with a really attractive valuations and a really bright future.
And so, just to get in a little bit more of the nitty gritty as to what you're investing in, is there any geography? Are you geography agnostic? I mean, talk to us about some of the finer details.
Sure. We are geography agnostic, but at the moment, led by opportunity and the most attractive opportunities, we are 60 to 70% exposed to US listed companies. And then the balance is skewed 2/3 Western Europe, 1/3 developed Asia.
And what about the impact of government policy? Because we've seen a lot of money being put into cleaner areas of the economy. We're seeing it all the time, even here in Australia. So how does that factor into any of your investment decisions?
One thing we'd like to start pointing out is that there's probably a misconception that many of these industries only exist and will only prosper with the benefit of government assistance, subsidies, tax breaks, etc. The misconception we'd like to move past is that fact, and that many of these industries, take solar for example, there are still subsidies in many parts of the world, but the basic fundamentals are what is driving that industry forward and driving growth, and that is rising electricity prices. And it is the lowest hanging fruit for an industry, a commercial business or a residential consumer of electricity to decouple themselves from those higher electricity prices.
Now, I don't want to be too cheeky, but can you give me an example of another company that you invest in, that you believe either will return outsized returns or already has, and just give us some of your thinking around that?
Very happy to. Let's take Enphase Energy. It's perceived as being just another one of the many solar stocks out there. We believe it's a bit different. Within the supply chain of solar, they produce inverters. Inverters are critical to turn what the panel produces, which is direct current, into alternating current, which we generally use in our homes. It's a segment that has a better industry structure and higher margins that are protected by IP and technology, and that's seen it generate higher margins over time. It will be a beneficiary of the incredible production growth of solar panels within China, and they are critical. You need an inverter for every one of those panels. They generate 20 to 30% free cash margins. They are growing at over 20% per annum, growing revenue at over 20% per annum, and you're paying a mid-teens multiple on a 12-month forward basis with a net cash balance sheet. That ticks all of our boxes in terms of those target characteristics and has got a compelling future.
And with all of the ESG mandates, you could think the big pension funds, you could think superannuation funds here in Australia. What type of a dynamic and overlay does that put on some of these clean energy investments?
Well, something that there's a lot of discussion about at the moment is the Your Future, Your Super legislation, which in the first instance has cleaned up some of the underperforming superannuation funds. But an unintended consequence is that it encourages, some would argue, benchmark hugging within superannuation funds to ensure performance hits the benchmark. The problem for clean energy is that clean energy stocks, as I mentioned earlier, are typically small. There are some notable exceptions, things like Tesla and NextEra Energy, but most of them are less than $10 billion of market cap. That means they're not in major indices and they're not on the radar of most investors. And that means they sit outside the benchmark. So for a superannuation fund to be investing in clean energy today, they're taking risk, and risk is not palatable in that situation. So the changes that may be in the wings to some of these performance benchmarks for superannuation funds as under Your Future, Your Super would only be a positive.
And when it comes to smaller companies as well, how do you talk to investors about risk? Because inherent in that exposure to smaller companies, there is more risk.
There certainly is. And we talk a bit about what the future could look like, but the world is an uncertain place and you are taking a higher risk. These are earlier stage companies. They're more volatile. A small section of our portfolio has not made a profit yet. They are not yet profitable companies. They're pre-break even. That carries considerable risks. We believe making sure our investors understand all of these issues before they invest, and we try to be as fulsome as we possibly can in our upfront disclosures, but our ongoing reporting also. And we believe that's about all we can do.
But when you think about clean energy as a megatrend, I mean, you cannot dispute the tailwinds that are behind it, both from a policy, perspective, but also just, a train that's already on track.
You're preaching to the converted, I fear. But you look at it from the top down.
Yeah.
Renewables, which have been around for decades, everyone knows about, people feel they're well understood. The amount of installed capacity to generate renewable electricity of just wind and solar alone are going to be 3 to 4 times larger by the end of the decade. The annual EV sales are going to be 4 to 5 times what they are today. And energy storage in the form of stationary batteries, that industry is going to be 10 to 20 times larger by the end of the decade. They are way beyond trivial levels of growth. You take something like smartphones, that industry is expected to be less than 1.2 times larger by the end of this decade. These are genuinely exciting, vibrant industries. We identify the most attractive, fundamentally attractive, managing risk and reward, and we build a portfolio around that, and we put that in the hands of investors.
One more sneaky question. Nuclear. Do you invest in nuclear? Do you consider that part of the clean energy transition?
Nuclear is zero emission electricity, and we do invest in nuclear. We don't have significant exposure at the moment. We believe the fundamentally attractive opportunities are hard to find. One of the major problems facing nuclear electricity is its current technology is not flexible. As you introduce solar and wind, which both have zero short-run marginal cost, it puts pressure on electricity prices in the grid, and that hurts nuclear, which can't be dialed up and dialed down.
Well, I could talk about this all day, so thank you, Roscoe. You're going to stick around to answer some of the questions coming in at the end, so we'll see you in just a bit.
Thank you very much.
That was Roscoe Widdup from T8.